From New York City for our viewers worldwide, I'm Bonnie Quinn. Bloomberg Real Yield starts right now. Coming up, core PCE shows the smallest gain of the year. Traders expecting the Fed to cut rates at least once this year. The Fed heads into its blackout period as the U.S. payrolls report now looms before the June FOMC meeting. And Treasury yields back off today as Wall Street digests the data and reconsiders steepeners. We begin with the big issue. The case for cuts gets more compelling.
Today's got to be a huge relief.
This is really what we were looking for.
Inflation starting to ease up.
I think that's really what matters most for the Fed.
The Fed continues to say we're data dependent.
I do notice the slowdown in spending, especially the real spending.
Inflation is still an issue.
No urgency for the Fed to cut rates.
What the Fed is still trying to do is gain confidence.
Inflation is coming down, but it is likely to be stickier than I think a lot of people expected.
While inflation is going to continue to decline, it's going to do it really slowly.
We're hopeful that we do get, further cooling in inflation.
I think we're going to get declining inflation at least out to September, maybe out to October. That should be enough for the Fed to cut.
Perhaps they will find an opportunity to initiate a rate cut this year.
Maybe you get one cut this year, and we'll see what happens in 2025.
Things can change, and I think that's especially true of the inflation data.
So quite an amount of optimism that this is actually dovish data here. And if you look at the data, you will see that it came in as anticipated, at least the headline and, of course, the PCE deflator as well. Some investors and strategists are talking about personal spending easing off just a little bit, but that could also be considered a good thing for the Federal Reserve if wages begin to decelerate just a little bit, and that hits the labour market, where, of course, the Fed has had a conundrum in how strong it's been. So again, taking a look at those data, you'll see month over month and year over year as expected and not wildly out of control, right? In fact, you could call this benign inflation data, although I'll leave the adjectives to our guests. We'll get to those in just a moment. Let's see how the two-year yield reacted, because of course we had seen a backup in the two-year yield during the week. Plenty of supply at those auctions. Well, today, after the data came out, we did see quite a precipitous drop in terms of drops that we've seen recently. We're at 488 now on the two-year. Have we seen the last of the five-handle for the year? That's another question for our guests. So earlier this week, Nobel laureate and former World Bank chief economist Paul Romer spoke about inflation and the direction of rates for the Fed. Let's have a listen.
If we stipulate that we want inflation to go down lower, there's still a question, should we be happy with a process where this happens gradually over time, or do we need to get there right away? And the Fed has not been clear about this. My argument has been, we've seen steady, continuous decreases in inflation, so there's no reason to be more aggressive and risk causing a recession. Wherever the Fed funds rate stabilizes, it's going to be at a level lower than where we are now.
A lot to pick apart. Joining us now, Parametric Fixed Income Portfolio Manager Nisha Patel and Wells Fargo Macro Strategist Eric Nelson. Thank you both for joining. Nisha, let me begin with you. Is it fair to characterize this morning's data as benign inflation data?
Yes, I would put it as benign. Again, the inflation data came in just as expected, and that's not a bad thing. What the market had been getting used to up until recently was just massive surprise to the upside. And generally, right, kind of being an outlier versus what was expected. So I think this is certainly refreshing in the sense that this is more in line with expectations. Now, over time, you may have those expectations being reset lower, but I think this is more a benign number. This is still a wait-and-see game. I think you have a solid 2 months of data that the Fed will want to digest, right, before giving any sort of a change in course, if you will. And so if you take a look at it from a timing perspective, that really kind of hits us right during that September meeting. So, as we kind of kick off summer here, I really think that benign data is a good thing. You almost want to, let's say, set it and forget it, let the data roll in, and let's see what the trend shows.
Well, Eric, we even saw Supercore decelerate from a revised 0.42% to 0.27%. So all in all, a very good day for Fed Chair Jay Powell. At the same time, is this a done deal, or could inflation show re-acceleration before the next Fed meeting, or before the one after June?
Yeah, I think that's a fair question. I also say that even at the current pace, core PCE inflation is tracking stronger than the Fed expected it to be in March. right? So they're running a little bit ahead of where their forecast was. So yes, this number came in as expected, but I wouldn't say it's the kind of thing that gets me, super excited about prospects for a Fed cut. Our base case is still September, but the message from Waller last week was it's going to take several good, i.e. soft or benign inflation prints to actually get there. And he actually gave the CPI print last month a C+. So he's not really a very generous judge. And it tells you that the bar for September is still high. And it's pretty well priced at this point, right? There's 14 basis points of cuts priced for September. So the bar to get there is high, and market's already somewhat there. So I may be a little bit on the other side and saying it's too early to get super excited about pricing in many more Fed cuts. We'll see NFP next week maybe is the best signal.
Yeah, what do you say to that, Nisha? Because some of this data can be bumpy, and if we were to see a reacceleration really anywhere across the spectrum of data, wouldn't that give the Fed pause, given that it said they need to see several months, and we don't know what several means, but surely it's more than 2 of lower inflation in order for them to be happy to start cutting?
Of course. I think this makes it a lot more difficult if the data starts kind of going in the other direction, and to your point, ends up being bumpy. I will say the recent data prints around labor, around inflation have generally been trending in the direction that the Fed wants to see it. But to your point, this makes this a lot more difficult. And if you start seeing outlier data that's showing otherwise, a reinflation kind of or a reignition in inflation, that's going to be a problem. Same with the labor markets, right? So we have those figures coming up soon. And in that case, I think you have any chance of a rate cut certainly being pushed back out to later this year or really kind of into 2025. So this is where obviously the Fed and the market is going to keep a very close eye on this. I will say, that the market is notorious for certainly pricing things in preemptively, right? So one thing that we keep looking at is, look, if we continue to have prints that are pointing to a disinflationary trend, to slower growth as a function of less consumer spending, you could see that really being priced into the market before the Fed even changes their narrative. And that's where kind of the opportunity is today.
For sure, and I want to ask you both if we've seen the end of the 5 handle for the rest of the year, at least. If we could say that, at least we'd know more, but we'll get to that in a moment. Nisha, I do want to ask you, though, September obviously has a slight problem attached to it in the sense that there's going to be an election in November. And, plenty of people think that will impact the Fed's decision. Howard Lutnick is one who thinks there'll definitely be a cut in September for that very reason. However, we constantly hear we will go in September if it's right, we won't if it isn't right. How much are you factoring in the fact that there's an election into the fact that, we do have an FOMC meeting in September and there is the potential for a move there?
Yeah, so look, I definitely think it is a factor. Now, I still think that the Fed is going to be much more, kind of skewed, obviously, towards looking at the actual data. But this is why in a year like this, where the election is taking place, I do think that September kind of timeframe just becomes a little bit more of a focal point, for exactly the reasons that you mentioned right before the election, but giving the Fed enough data or time to process the data that's coming over the next 2 months. So, not going to say that it's not going to be a factor. But again, look, the Fed is going to operate independently as well. So if cuts are warranted and if there's enough disinflationary trends, it's not to say that they couldn't go, after September either, closer to the election timeframe.
Eric, can we at least say that the idea of an increase being the next move is now potentially put back in the box?
At this stage, yeah, Powell's been very clear, and frankly, most policymakers, with the exception of Kashkari, who recently has been more of an outlier than anything else, seem pretty uncomfortable even talking about rate hikes. I think anything's possible. It would take, I think, a very significant upside surprise, mostly on inflation expectations, as well as spot inflation, of course, to get the Fed to hike. And that's at least 3 to 6 months of very bad inflation. I'm talking not just 0.3s and 0.34s. This is a real tail risk scenario. To me, the Fed is just very happy to not cut and see how the market absorbs that. And that's kind of their hawkish kind of outcome, in my view.
Exactly. I mean, we all know the worst case scenario is for the Fed to have to increase and then cut and sort of backtrack on what its plan would have been originally. Eric, are investors too invested in the short end?
Well, honestly, I think the challenge here for parking in the front end and 2-year specifically is the carry profile is really challenging, and there's still a lot of supply in that area of the curve, and so what we're hearing from a lot of investors is they're kind of trading the range, right? So up around 5%, they're happy to participate and get long in the 2-year space, but around here or 10 basis points lower, maybe they want to kind of go the other direction. And until there's a much clearer signal that cuts are coming, right? We have to hear this. We have to see it in the data, and we're just not there yet, and we're hearing the same thing from investors.
Nisha, let me ask you, what's a nice trade here? I mean, volatility has been subdued. Is volatility trading a potential, or do you look elsewhere?
Yeah, look, I just think that this recent inflation data just ends up becoming a little bit more of a supportive macro environment, right, for fixed income investors. So as we talk about, in most common conversation with our clients at Parametric is you're either sitting in cash or, again, looking back at that 5% yield bogey, I do think that that's passed. So when you take a look at today's yield environment in relative terms, we're still sitting at over decade highs. We're still looking at very opportunistic entry points here from a fixed income perspective. And our bias would be to be within investment grade, more kind of a higher quality bias. So I do think that the carry there is very attractive, particularly, in the markets of some preferreds. So preferreds is a market that we prefer over high yield credit, simply because high yield credit spreads are simply compressed, right? We've seen a lot of the economic environment being priced into spreads there. We need a little bit more of a liquidity premium. Preferreds, your higher kind of quality banks, which are making up most of the issuance there, you're getting about a 7% yield, most of which is QDI. So on a tax equivalent basis, those are the types of markets that you start looking at those types of yield levels that starts becoming increasingly opportunistic. So we're encouraging our clients, this is the place to add some duration in your portfolios. The carry here is very attractive. Again, and I go back to if the market really starts pricing ahead of the Fed doing anything, if the data continues in the right direction, this could be a really good opportunity from a price appreciation standpoint.
All right, exciting times. Our thanks to both of you very much for joining us today. That's Parametric's Nisha Patel and Wells Fargo's Eric Nelson. Up next, the auction block. Weak demand for Treasury auctions. This month marks the lowest aggregate bid to cover for coupon auctions since 2021. A look at issuance and credit next. This is Real Yield on Bloomberg. I'm Bonnie Quinn. This is Bloomberg Real Yield. Time now for the auction block, where this week we look at sovereigns and corporate credit. We start with treasuries and a trio of pretty somber US auctions. The 2, 5 and 7-year notes all drew higher than anticipated yields and weak bid to cover ratios. May was the lowest month for aggregate bid to cover since 2021. Moving to US high grade, May's volume finishing over $133 billion, making it the 5th straight month where actual sales exceeded expectations. This week's sales were led by names such as Morgan Stanley, Scotiabank and Owens Corning. And over in Europe, bond issuance this year now tops €1 trillion. It hit that mark at the fastest pace on record. Just under half the debt sold this year has come from supranationals, sovereigns and agencies. Sticking with credit, Kathy Jones with Charles Schwab sees opportunities.
If you can lock in investment-grade corporate bonds at 5.5%, 5.6%, if you can lock in some of the agency paper at these yields, even highly rated municipal bonds right now on a tax equivalent basis are very high. So what we're referring to is not just a treasury market, but other areas of the fixed income market where there's opportunity to, hold on to these yields for 5 to 7 years.
For more, I'm joined by Brandywine Global Portfolio Manager John McLean and BNP Paribas Head of US Credit Strategy, Megan Robson, who joins me in studio. Thanks to you both. So Megan, let's start with you. I have to ask you, We're getting 85 basis points if we're lucky as a spread. Is that enough to take a position in IG, or for that matter, high yield, where we're not even getting more than 350 basis points?
Yeah, so thank you for having me, first of all. So spreads at multi-year tights in credit, but yields are still compelling. So I think the motivation to buy credit here really is more about the carry and all-in yields. But stepping back from a macro perspective, look at today's PCE report. Coming in at expectations. It's the second inflation report we've gotten that is in line with consensus. And we think that means macro risks are more moderate. Also more specific to credit, you just went over some of the elevated supply that we saw this month. We expect that to slow into the summer. So I think a more moderate backdrop in combination with seasonally supportive supply for the summer in credit means we can stay at these spread levels even though they are at tights.
I mean, it does seem just a little bit strange that we've had those tights and this amount of supply for so long and nothing has really cracked, nothing has moved. But we've seen so many repricings in the Treasury market. Is there any possibility in your mind that there could be any kind of an episode between now and year end?
Focusing on the Treasury market rates, I think a key risk is going to be higher Treasury supply as we move forward, given elevated fiscal deficits. And our view is that we're going to see stability in the long end of Treasuries. So our forecast is that we'll stay around the midpoint of 4.5% or so in the Treasury market. Yes, there's upward pressure there with some of the Treasury supply and potential policy risk coming in and fiscal deficits. But on the other side, you also have growth slowing. So there will be an offset there. And in our view, you're actually going to see more stability in the long end of the Treasury curve.
So more stability then, John. Let me return to you with that question.
Yeah, stability in the Treasury market, though, I think supply and demand is an issue here. And I think we're going to see more supply down the road. And I'm not sure about the actual demand. I think what we're seeing is allocators shifting away from kind of the core, from the rate market into the lower quality part of credit markets. So I think that the supply and demand technical around Treasuries is not very good. Whereas what we're seeing in corporates, particularly high yield and leveraged loans, is a lot of demand and not enough supply. So we feel really confident that spreads are going to remain relatively tight, particularly over the next 3 to 6 months here in both high yield and in loans.
John, we are, though, seeing a bigger proportion of potential fallen angels. I mean, they haven't fallen yet, but we've definitely seen that increase. Any concerns about particular areas of the market or particular companies or particular geographies that you would want to stay away from?
Yeah, I mean, look, like the triple C part of the marketplace has been talked at nauseum. Like access to capital for a lot of these companies isn't really there. So there is some worry on the tail end of both loans and high yield. In terms of sectors, media is certainly an area that has been challenged and we think will continue to be challenged. Cable's one which has been challenged, but we actually think there are some compelling opportunities now that there's real yield attached to asset-rich companies. But, you know, in general, in terms of the rising stars versus the fallen angel component, there will be some fallen angels. But what we've observed historically is now that as companies fall into high yield, you're dealing with bigger, more liquid capital stacks, and spreads actually tighten going into high yield coming from investment grade. So that's a good opportunity from our perspective to buy in front of the downgrade. It's the exact opposite of what people have historically said. And the same holds true in terms of rising stars going into the investment grade universe. They're bid up too much in the marketplace before they go IG. But we see relative balance between the two right now. I'm not worried about a meaningful amount of downgrades.
That's fascinating. Megan, would you agree? Buy the angels before they've fallen?
So I think in terms of tail risks and credit concerns, we're focused more on the lower end of high yield. So as we said, spreads at multi-year tights, but what's unusual is you have seen a rise in the distress ratio in high yield. So you have about 5% of the market is trading over 1,000 basis points. It means there's major concerns about the sustainability of those businesses. As John mentioned, some in telecom, some in falling into media. What we're looking to do is avoid the biggest names that could potentially fall into that tail. So looking at things like elevated leverage, and also names that are showing revenue growth that is below trend. I think those are going to be key factors to predict what names are most at risk next. But Overall, we're still constructive on IG, so the BBB part of the market, I think, is actually still an opportunity, whereas the risks we think are skewed to lower end high yield.
To both of you, real fast, John, favorite geography ex-US?
Well, I'm going to say Europe because of supply-demand technical. There's been no net issuance in European high yield.
There you go. Europe, Megan?
We also would choose Europe, so our forecasts build in some outperformance for European credit relative to the US as well.
All right. That's an agreement, a point of agreement for both of you. In fact, I think you've agreed on much of everything today. Our thanks to Brandywine's John McLean and BNP's Megan Robson. Still ahead, the final spread the week ahead features a US jobs report and a rate decision, as we've just been saying, from the ECB. Stick with us. This is Real Yield on Bloomberg. I'm Bonnie Quinn. This is Bloomberg Real Yield, and it's time now for the final spread the week ahead. Coming up, Monday features the IATA meeting. We'll hear lots about the airlines during that time. The week also sees fresh economic data out of the US, from manufacturing to durable goods, also JOLTS. It'll be a three-day extravaganza of jobs data. We'll see rate decisions from the Bank of Canada and the European Central Bank, and of course that all-important non-farm payrolls report on Friday. And one final thought, a look at expectations for that report. We'll be watching, of course, for the overall number, how soft it will be, whether it will be softer from the previous month. Right now, expectations are for a gain in May of 180,000 jobs, with the UE rate staying at 3.9%, but of course that will change over the next few days. The wages data, average hourly earnings, will be in focus after the personal spending and personal income data today. We're actually looking for a gain there to 0.3% from the previous 0.2%. From New York, that does it from us. Same time, same place next week. This was Bloomberg Real Yield on Bloomberg.